We have three excellent speakers today talking about the Canadian upstream oil sector. First off, we have Derek Aylesworth. He is the Chief Financial Officer of Seven Generations. Then we have Rodney Gray, who's the Executive Vice President and Chief Financial Officer of Baytex, followed by Lars Glemser, Vice President and Chief Financial Officer of Vermilion Energy. Thanks for joining us, gentlemen.
Thanks. Good morning. Great.
So wanted to start off and just kind of go through each person, and if you could tell us a little bit about your company and how you guys have been surviving the year of the pandemic. Derek, if we could start with you.
Sure, thanks. So I'm the Chief Financial Officer for Seven Generations. Seven Gens is a Western Canadian producer. We're exclusively operating in the Montney Formation. The Montney is one of Canada's largest resource plays. We focus largely on the liquids rich, and as a result, we're Canada's largest condensate producer. The company today is guiding to produce between 175 and 185,000 BOE per day for the 2020 calendar year. Condensate is a bit of a unique product in Western Canada. It's the only hydrocarbon product that's structurally short in Canada. The primary use of condensate is as a diluent for oil sands producers to blend with their production to allow the product to flow down a pipeline. Today, Canada's needs for that product are in the range of about 700,000 barrels per day, and Canada produces about 420,000. So that structural shortage we foresee continuing, and I think that bodes well for the outlook for the commodity price. How we've done during the pandemic, like everyone, this was a challenging year. Last year, we were producing about 200,000 barrels a day. And coming into the 2020 year, we had set a preliminary budget last November to invest $1.1 billion in a capital program. With the combination of the Saudi and Russia price war and demand destruction from the pandemic, we reset our budget earlier in the year to a capital expenditure level that we thought would be able to be self-funded in the prevailing commodity price environment at the time. That resulted in us pulling our capital budget back to $650 million, and there was a consequent reduction in our productive capacity down from about 200,000 barrels a day last year to that range that I quoted earlier. At that expenditure level, we do think we'll be able to self-fund this year. In fact, with a modest recovery in commodity prices from since we made that adjustment, we're now expecting a degree of free cash flow generation this year. So in addition to pulling back our capital program, we did get very, very aggressive with our hedging program when we started to see signals that commodity prices could soften. We locked in about 85% of our WTI exposure for the balance of the 2020 year at just over $45 WTI. And that level of hedging carries on through the first quarter of next year. We recently started to see condensate prices improve as oil sands production has come back online, and we think we're well positioned for a continuation of a commodity price recovery.
Great, thank you. Rod, tell us a little bit about Baytex and how you guys are surviving this year.
Sure, thanks, Catherine. Similar to Derek, it's been a very challenging year. We got started off the year very busy on the capital front. We basically issued a new series of bonds, which are due 2027. And we actually took the opportunity to retire a bunch of other bonds that were maturing in 2021 and 2022. And so what that did is give us the opportunity to renegotiate our bank credit facilities out to 2024, which is our nearest term maturity. So just a little bit of background on Baytex. We are basically an oil and gas producer, predominantly crude oil and liquids. We have properties in Alberta and Saskatchewan in Canada. And then we also have a non-operated interest in the Eagle Ford. Our production would be split about 60% to Canada, which is kind of a mix of heavy oil and light oil, and then the light oil properties that we would have in the U.S. and the Eagle Ford. 2019 was a great year for us. WTI averaged about just over $56, and we were able to generate over $300 million of free cash flow. And we've been really focusing on trying to generate free cash flow to delever our balance sheet. We've had a little bit more debt than we wanted to when we came into the commodity price downturn. And so we've been adjusting our plans to basically create free cash flow and deleverage the balance sheet. But the activities at the start of the year were really focused on, that sending out the new series of bonds and basically setting up our maturity stack. And then quite quickly after that, we got into the COVID response. And our initial response was basically ensuring the safety and health of our personnel as well as our operations. And that quickly evolved into, once we had people working from home, which happened very quickly, retooling the business. And so, give you an example, we spent just over $177 million in Q1. We basically stopped capital spending in Canada and moderated our pace of development in the US. And in Q2, we invested only $10 million in our assets, and we were still able to actually generate free cash flow during Q2, which was an extremely volatile period. We're now focused on 2021 and what our plans are looking for 2021. And I'd say our focus is really on retooling the business to the new commodity price environment. And so if we're in a $40 to $45 environment, we're basically spending enough cash flow to keep operations stable. And then as commodity prices improve, we're looking to take the opportunity to use that free cash flow to delever the balance sheet. But essentially at lower commodity prices, we're going to be spending cash flow to maintain operations as best possible. And as prices move up, we see that going to the balance sheet and further delevering. Just to put that into perspective, we see ourselves at $45 WTI. We're able to sustain our operations in that 75 to 80,000 barrels a day. And that would be investing about $300 million of capital, kind of 50-50 between our US operations and our Canadian operations. So maybe I'll stop there at the risk of rambling on. We can talk a lot about Baytex, but everybody's here. So I'll stop there.
Great. Lars?
Great, thank you. So Vermilion Energy is an internationally diversified company. To put it into perspective, we've got about 60% of our production coming out of North America for 2020, 35% Europe, 5% Australia. Production guidance for 2020 will be in the range of 94 to 98,000 barrels a day. So, I think what we really provide is a diversified business in terms of commodity price exposure. The way to think about Vermilion from a commodity perspective is light oil and condensate is the primary investment in North America. Light oil in Saskatchewan, condensate in Alberta, light oil in Wyoming. And then Europe, we do have exposure to Brent crude as well as the European gas pricing side. Depressed price environment here in 2020, I think the thing we'd like to point out is strip pricing for European gas in 2021 projected to be in that $6 Canadian MCF range. So, I think that's what you get with Vermilion is that diversified portfolio. In terms of response to the pandemic, I think the way to think about Vermilion's asset base is very short cycle investment in all three of our jurisdictions. So we started with initial capital guidance for 2020 of $450 million. We've now cut that back to $360 million. In addition, in the past, all of our free cash flow, or a good chunk of it, was used to fund the dividend. We have now suspended that. So in conjunction with the capital program, as well as some cost cuts through the rest of the business, we've eliminated about $520 million of cash outflows from the business. So that's been Vermilion's response from a financial perspective in response to COVID. In addition to that, similar to Rod, we extended our credit facility as well in March of this year. That is a covenant-based credit facility, which is now termed out until May of 2024. And then, as most of the folks on the line here would be aware, we have the high yield notes outstanding. Those mature in March of 2025. So a pretty good maturity stack from that perspective. And with that, I'll turn it back to you.
Great. So Lars, just you will circle back to you since you were just talking about credit and financing. I guess one of the big topics that we've seen in the last few years is the retreat of foreign players and partial divestitures or full divestitures. I think according to Bloomberg calculations, as of last year, we had about $30 billion in foreign company divestitures, and trying to understand what that means for a company like yourself, for Vermilion. Is access to capital really that difficult? And what does that mean for the sector as capital markets are shunning the energy sort of E&Ps?
Yeah, so I think we keep very close tabs on the majors in terms of their M&A plans or divestiture plans. I would say historically, Vermilion has been an acquirer of assets from the majors in Europe, opposed to North America. So that's where we really try to keep tabs on that group of companies. Now, in terms of how you fund acquisitions, I think in the past there was a little bit more ability to access capital market, whether that was debt or equity. I think that access to capital markets is getting a little bit more stringent, expensive in this kind of environment. So in addition to the asset attributes that anything would have to meet, we would also have to be delivering on our balance sheet priorities as well. I would say our number one financial priority is debt reduction and leverage reduction. Therefore, any kind of acquisition, whether it was from a major or anyone else, would have to check the box on that balance sheet deleveraging as well. I think the advantage Vermilion has is the European franchise that we have built. What that allows us to do is look at acquisitions where price is not always the number one driver in a transaction. Things like asset retirement obligations and indemnities around those, reputation within Europe, a lot of those have a lot of value in Europe. So that continues to be an advantage for us going forward as majors execute on divestiture programs.
Right. And Rod, you had talked about, I think the term you used was retooling your books or retooling your balance sheets, and you had talked a lot about free cash flow. I mean, how does one manage that? How does one manage that with prices at the levels in which they are in the sort of late 30s and 40s, and how do you achieve that?
No, good question. It's getting a good handle on your assets and understanding where your margins are and where your profitable assets are. And through the downturn during Q2, we had actually shut in about 25,000 barrels a day of production, and that production just wasn't generating a positive margin for us. And so being able to be very, call it nimble, to move and shut down operations where you're not generating profits, and basically reduce any losses that you could incur. And so we've got a great understanding of our assets now. We did experience the downturn in 2016, and through that we also shut in production, but we bring that production back on as soon as it's going to generate a positive margin. And so it's really working closely with your assets and your field teams to make sure that you understand fully the operations and the cost structure that you have, and optimizing that for the environment. But second to that is also relying on a good risk management program. And so with that, we refer to our hedging programs or our long-term contracts. And we lean on those contracts during periods of volatility to make sure that we have operational flexibility. And so I think our teams have done a great job in terms of bringing production back on. Now we've seen commodity prices come back to some extent, and we've been able to bring essentially all of that 25,000 barrels a day that we shut in back online.
Wow. And so for the question for the three gentlemen is, what does your capital spending look like for 2021? What does your production guidance look like for 2021, given where prices are at the moment and given how you guys are thinking, especially since we're at the end of the year? Derek, we could start with you.
Sure. Maybe before I dive into the specific answer to your question, maybe I'll just pile on the theme that the priority for our company is at the moment deleveraging. And the deleveraging opportunity for us is coming from an ongoing maturing of the business. The company was a private equity-backed startup, and all of our growth has been organic, largely been organic. We went from a standing start to that 200,000 barrels a day that I talked about earlier. One of the byproducts of that was corporate decline rate that maybe got ahead of where we would have liked it to be. So a couple of years ago, we made a conscious decision to stop pursuing production growth and be more focused on economic return for shareholders and bondholders. That slowing of the pace of growth has allowed our corporate decline rates to mitigate very substantially. And that's been our strategic direction for a number of years now. When we look going forward into 2021, we expect to see just have a continuation of what we've been doing for the last number of years, which is, in other words, holding productive capacity flat and very relentlessly focusing on cost reduction. That would imply that we'd be spending next year between $650 and $700 million on a capital program and holding production flat there. I think the real story there, though, is with decline mitigation and with pretty significant improvements in the costs to drill, complete, and tie in our wells, our corporate financial break-even has been steadily coming down and is projected to continue to come down. A couple of years ago, we would have expected that we needed a $55 WTI world to self-fund staying flat. Coming into 2020, we now think we're around 42. Going into 2021, that's probably coming down a couple of dollars further. So we're very, very much focused on making a business that's more resilient in more modest commodity price environments. The cost reduction that I alluded to is pretty substantial. Our drill complete tie-in costs for the first half of 2019 were just under $10 million a well. For the first half of this year, we were around 7.1 to 7.4 on the second quarter and the first quarter. So very, very dramatic cost improvement. Quite often people have been asking us how much of that is on the back of suppliers that are desperate for work because of the COVID situation. And my answer is none of it. All of those results were delivered pre-COVID and really are a function of changing the way we've scienced our wells and modifying the well designs and completion programs and doing some fairly aggressive work in terms of supply chain management and capturing some longer term contracts for some of the value chain. So as we look forward into next year and years beyond that, I would expect that our plan doesn't change very much. Continue to drive costs lower to the extent that we generate free cash flow. I use that to delever. And when we hit our balance sheet targets, which I think we could probably hit within a year or two, then we'll revisit the opportunities to utilize that free cash flow, whether it's dividend, NCIB, or some modest degree of return to growth. But next year looks relatively similar to this year, just with a better cost structure.
Got it. Rod, how about you?
Yeah, so similar to Derek, I think we've seen great strides in the business in terms of building efficiencies, and I think through one thing that's happened for us in particular is the downturn's given us an ability to kind of reset production levels. And so we used to produce about 95 to 100,000 barrels a day. Now we'd be between 75 and 85,000 barrels a day. And so with that, and that's happened through a reduction in capital spending during 2020. But what that's done is we've actually seen a reduction in our overall decline rate, much like Derek has said. So our corporate decline rate before used to be about 34%. It's probably down to 29% now. When we set our 2020 capital budget, we would have had capital efficiencies that would have been about $17,000 a flowing barrel. We're now projecting that to be about $15,000 a flowing barrel. And similar to Derek, where 2 years ago, we would have needed $55 to sustain our business. We now see our business being sustainable in a $45 environment. When we look at our plans for 2021, we haven't set them yet. We will set, our budget will be released in early December after we meet with our board. But I think the key to the budget is it's going to be flexible. In a lower commodity price environment, we're going to be spending less and trying to generate as much free cash flow or just spend cash flow at definitely the low levels. But at $45 environment, we can actually generate modest free cash flow and keep our business flat. And so we'll probably be going out with a program that's somewhat predicated on a $40 to $45 world, but remain adjustable or flexible should commodity prices change. And so the other thing that we do have, similar to both Lars and Derek, is we've managed to build up a bit of a hedge book for 2021. And right now we'd have over 35% protection at $45 WTI that actually allows us price participation up to $55 WTI. So we're feeling good about that protection. We'd like to have more, but we'll see where commodity prices go over the next little while here.
Got it. And Lars, would love to hear about Vermilion, particularly since you guys have the international presence as well.
Yeah, absolutely. Similar to the other two, we took the drastic measures of stopping the drilling program earlier this year. So from a production profile perspective, that will have an impact going into 2021 in terms of no capital investment offsetting some of those PDP declines through the second half of 2020. From a decline perspective, you can think of Vermilion kind of in that low to 20% range in terms of what that decline level is. So I think we have an advantage from that perspective. And then, because a lot of our investment is into either conventional or semi-conventional reservoirs, a lot less capital intensity than what you see in the unconventionals. Therefore, I think that we are able to, remain nimble and be flexible as we move forward. I think in terms of 2021, you look at 2020, we spent about $230 million of our $360 million program in Q1. I think there are some efficiencies to be had by level loading that throughout the year, utilizing the best rigs and that type of thing. So, I think consistent with Rod and Derek, we'll be more focused on longer term profitability as opposed to quarter to quarter or even annual production growth. And then what that also allows us to do is to remain nimble. And if we have a commodity price environment that is lower than what Strip is suggesting today, we'll have to react. Vice versa, if we have a commodity price environment that is higher than today, we'll be quick to react in that environment as well in terms of sort of balancing the capital allocation between the balance sheet, organic investment, as well as acquisitions.
And to follow up on that, Lars, at the beginning when I asked if this question, and Derek had mentioned, cost savings from the technology side. What are you guys seeing in terms of if cost savings from oil field service providers? Obviously, it's been a sector that's been hit very hard, and wanted to see if when we talk about cutting expenses and have we gone to the bottom in terms of the service providers yet? Is there more savings there in that aspect?
Similar to the other two, we haven't had much of an active program sort of since COVID has taken impact. I would say, there's not a heck of a lot more that service providers can provide from a cost saving perspective. I think the way we look at it too is our operating cost budget is approximately $450 million in absolute terms. That is much larger than the $360 million capital budget. I think that we'll look to there to make some more structural savings. Now, savings on that side of it take longer. They take some investment. There's no sort of silver bullet in terms of something that you'll see next quarter type thing. But I think that's where the business will really refocus is, on the operating side of the business as these capital budgets get shrunk and shrunk.
Understood. Yeah. Want to turn it over a little bit to M&A and consolidation. Obviously, we are seeing some of that in the U.S. and it's been long talked about up in Canada. Rod, what are your thoughts? Do you think that we are ripe? The Canadian basin is ripe for some sort of major wave of consolidation, some sort of M&A?
I think we're starting to see some transactions take place, but I think both Lars and Derek touched on it a little bit in terms of when you do look at a transaction or an asset acquisition. For us in particular, we focus on asset quality and how that asset's going to compete within our portfolio. We have over 10 years worth of organic drilling opportunities on the lands that we hold today. And so any asset acquisition that we would look at or M&A transaction going forward you got to look at the attributes that are there, and you don't want to just do a transaction. You know, historically, people have maybe looked to grow by transaction, but I would say people are looking for definite synergies and reasons for transactions to happen, and they've got to tick all the boxes, whether it be you know, operational synergies, capital efficiencies, G&A savings, maybe the balance sheet in terms of fixing things there. But I think there is going to be more activity, but I think it's going to be very transaction specific in terms of making sure that all the boxes are ticked for the money managers when they're looking to make sure that the transaction does make sense.
Yeah. Derek, what are your thoughts on this topic?
Yeah, I think that there's a very recurring theme right now that with the commodity price reductions and the resulting valuation reductions, oil and gas companies are diminishing in investor relevance. And it's harder and harder to get investor attention as companies, even Exxon, are falling out of major indices these days. So there's been a fairly, as I said, recurring theme that scale is important just to counter that. I think I subscribe to that theory. Scale usually comes not only with relevance, but it comes with efficiencies, comes with possibly product and play diversity and geographic and political exposure diversity. All of those are potentially valuable things. And then I'd repeat what Rod had to say. As a company like us thinks about M&A, for sure, there's different buckets of value that you can try to capture. Potentially valuation re-ratings from scale, potentially the synergies bucket. When we think about M&A and where we might most appropriately capture synergies, it would likely be consolidation within the Montney. But for us, when we look throughout the Montney, we're already the most liquids-rich producer in the Montney. We have a longer-term bullish outlook on the way condensate will behave. So to consolidate within the Montney would minimize our exposure to that particularly strong product. Potentially that can be counterbalanced with synergies. Potentially, if you get enough scale, investment grade is on offer, and that's of course of interest to the viewers of this panel. I think that there will be more M&A, absolutely. I think most of the transactions that you've seen to date have been transactions where one counterparty is in distress. What you've not yet seen is combinations where two strong companies are coming together. I might say Devon and the WPX are the example that proves me wrong there. But generally, you've not seen strong companies combining. I think that that's going to be the next step for us. In order to move forward with M&A, we need to find something that competes with our internal inventory. And frankly, there's not very much. The rates of returns and the PIRs that are in our internal inventory literally are amongst the best in North America. And we've got probably 20 plus years of identified inventory in the upper and the mid Montney. There's an emerging play in the lower Montney that could add 5 to 6 to 7 years to that inventory if it continues to develop the way that we're seeing it so far. We don't have a need for M&A per se if there's a way to make our company better. And by better, I mean more capable of delivering free cash flow throughout different points in the commodity price cycle. We might be interested, but it's a pretty high bar for us.
Yeah. We don't have a lot of time, so I want to run into a quick lightning round. How is this going to work is Derek, Rod, and Lars. I'm going to do it in that order, and I'm going to ask you a question. I want 1 or 2 word answers if possible, and want to get a quick thought and no explanation. Are you guys ready?
Sure.
All right, let's start. Let's start here. What number, WTI, do we need to see across the board growth again? Derek.
50 plus.
Rod.
50 plus.
Lars.
60.
Do you think that by mid-year 2021 we're going to see a big wave of industry consolidation? Derek.
No.
Rod?
I'm agreeing with Derek again. No.
Lars?
No.
Okay, biggest political risk going into the year end 2020. Derek?
Biden winning the election.
Rod?
Uncertainty over the election.
Uncertainty. One more word. Okay, elections. Lars?
I agree with Rod. Hung election results.
Okay, biggest political risk going into 2021. Derek?
Exposure to retreat from support of the hydrocarbon industry.
Okay, Rod?
Yeah, along those lines, just more regulation and that is basically adding cost and incremental challenge to the industry.
And Lars?
Yeah, I'll stay on theme. Regulation that doesn't align with reality.
Okay, I got two more for you guys. Next pipeline that will come into service between KXL, TMX, Line 3 replacement, or Line 5? Derek?
TMX.
I think Line 3. Line 3 will be first.
Lars?
I'll go Line 5.
And last question. Will we see, and I'm not even going to say $100 oil, but $80 oil in the next 5 years? Derek?
No.
Rod?
I don't necessarily think we'll see 80, but we're going to see a more constructive environment because the investment that's required in order to keep things going has definitely gone down.
And Lars?
No.
No. Well, thank you so much for joining me. This is obviously would love to spend hours chatting more. And this has been a very, very insightful conversation. Thanks, gentlemen.